So joining us to discuss the stock market is Daniel Lacalle, author of Life in the Financial Markets, also the chief economist with the Tressis Hedge Fund. Lacalle helps manage over $6 billion of assets with Tressis. Daniel, great to see you as always.
Thank you very much. Thanks for having me.
Daniel, I think one of the big themes of the pandemic so far has been that stocks are overvalued, right? People would point to the fact that stocks have risen much faster than company earnings have risen. Some analysts, they justified it by saying, well, in the future, when things get back to normal and restrictions are lifted, then the earnings will rise in tandem. Looking at the latest earnings quarter, you've been following it. Has this been justified?
Not necessarily. And I think that what this earnings season so far is showing is that, yes, companies are beating analyst estimates, but they're beating by a very narrow margin, and mostly because the EPS is rising faster due to buybacks. No?
That's the earnings per share, Daniel, right?
Exactly. Earnings per share are showing better figures than analysts expected because of buybacks, because when you buy back shares, the share count comes down. No, so earnings per share rise. But operating profits are not as strong as many expected. And I think that the key in this earnings season is not so much what they have published, but what they're guiding. Companies are guiding to weaker profits. They're also guiding to much lower growth. And I think that important one is, and the reason why the stock market has reacted so negatively in the case of some banks and some of the industrial companies, is precisely because what they're saying is that margins are going to be significantly lower. So we are already seeing a small process of downgrades of estimates that is very healthy, to be fairly honest.
So we're saying guidance, Daniel, that's looking forward at companies' future earnings. When you're listening to the CEOs, et cetera, on their earnings calls, what are they putting this down to? Why the negative outlook?
When CEOs talk about the future, they tend to point to lower margins because of rising input costs due to inflation, because of weaker growth in sales, because of the lower disposable income of families, also due to inflation. And also there's an important factor, which is that it's the analyst community that was extremely optimistic. I think that what CEOs are doing with their guidance is reminding analysts that the rosy picture that many of them had for 2022 and for 2023 was too aggressive. And they're basically bringing people's expectations to a more normal environment.
So let's talk about the household income, because I think this is an interesting point. I think while stocks were rising and loose monetary policy was happening, a lot of people were saying, well, I'm invested in stocks. It's not a big deal. Stocks only go up. But eventually, these companies, they make their money from households. They make their money from businesses. And as you mentioned, through inflation, their households' purchasing power is falling. Now, we had Lance Roberts on the show, I think, at the beginning of this week. Lance seems to think that inflation has peaked. He thinks it may start to come down this year. Well, what are your thoughts?
Inflation may have peaked, and I think that Lance has an interesting grip on what can be the outcome into the second part of the year. The problem I have is that even if it happens, and I think that Lance Roberts would agree with this, is that inflation is accumulative. So you're already losing the purchasing power of 2021, and you're going to lose further. So the only thing that is going down is the pace of acceleration of inflation, not inflation. So prices are not coming down. Prices are going up less quickly than before. So that's my problem. Because the people that probably rightly, inflation is very difficult to analyze, but the people that basically think in 2022 you're going to have sort of 4.5% inflation, while you had 7% in 2021, what they're basically telling you, and rightly so, is that you're going to have almost 12% loss of purchasing power in 2 years. I don't think that many people that are watching us right now are going to see their wages go up by 12% in 2 years.
It is so true, Daniel. It's been an incredible couple of years. Daniel Lacalle, Trez's Hedge Fund. Appreciate it. Thank you.
Thank you very much.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.